Yes. So, hi everyone. Hope I'm audible. So, good evening. So, welcome to the new session of Jargon Buster Webinar Series. So, I'll just share my screen. So, my screen is visible. Okay. Yeah.
Yes, it is.
Yes. Okay. So, in today's session, we are going to discuss about financial modeling basics. So, this is actually a like kind of a practical session. But I'll be like kind of. I'm not going to take you through a financial model per se, but I'll be like kind of helping you to understand how to build a financial model. See, I'm not like kind of what I'm not telling that after this session you will be able to create a financial model on your own, but you will have an understanding of what a financial model is, what are the core things that you need to have in a financial model, and what is the important purpose of like kind of making a financial model. All these things you will be able to learn from this session. And after the session, hopefully I'll share you a couple of templates of financial model which I have already built for a few other industries, which may be like kind of for use for you also. Okay. So financial modeling basics. So understanding how business convert assumptions into financial projections. So the first question first. So what is financial modeling? So financial modeling is actually the process of like kind of converting the business assumptions into numbers and understand like kind of how the business is going to perform in the future. So see, as a founder, like everybody of you would be having an idea of what is the revenue that you're going to do, and in order to generate that revenue, like how much people I need to hire or what sort of products I should be purchasing. Everybody have a vague idea on that. So when we put these things into an Excel or a spreadsheet and work out like kind of how the outcome of the business is going to be, that is actually called a financial modeling. Okay. So the key elements of financial modeling are revenue, expenses, cash flow, funding requirement, profitability. Okay. So there are a few other elements also to financial modeling. Even we can include valuation, all those things as well. But I'm not touching upon those areas. Like I've told, this is a basic session. So we are trying to understand like kind of what are the core elements and like kind of how do we create a financial model. Okay. So these are the main five elements of financial model. And like I've told, like it's the process of translating the business assumptions into numbers and understand how the business is going to perform in the future. Like if you can see the this one, like it answers one core question. So if the business plan works as expected, what will the financial outcome look like? So this is a question that a financial model address. So if everything goes as per what we have planned, what is the profit going to be? What is the cash flow going to be? How much fund you will be required? How much fund you will require to like kind of run this business? All those questions would be addressed if like kind of we create this into a spreadsheet. Okay. So why financial models matter? So typically like kind of people assume that financial model is needed to like kind of send to investors only, but that's a kind of a wrong notion. So obviously like kind of for investment you need to create a financial model, but that is just one element of financial modeling. Okay. So apart from that, like even if you're raising investment, even if you are not raising investment, my suggestion is that, or like kind of for a better business practice, you should always create financial models. You should be having like kind of uh, plan on like kind of what you are going to do for the next 12 months or say next 24 months or whatever period you are going to build the financial model for. Okay. So the why people typically build financial models, the main five reasons why I've noted is that one is to plan growth, like how you're going to grow in the upcoming years or like kind of months. Then estimate funding. So if you are a business and you want to like kind of grow from 10,000 to 1 lakh, so what is the fund that you require? Because see, typically like kind of the problem with most of the business is that they won't be having enough fund to deliver the expected result that they want to deliver. For example, be it a consulting business. So it's a manpower oriented business. For example, you have enough of sales coming in. You have a good reputation in the market, and people want to like kind of reach out to you for doing consulting and everything. But the problem is that you don't have much manpower. And since you don't have much manpower, the problem is that you will not be able to take more works. Even though you have good demand, have good sales, you will not be able to take more people. So in that scenario, like kind of you would be required to get some funding. It can be a debt, it can be a investment or whatever it be. So to estimate funding, you need to create the financial model. So in such scenarios, you project how your 12 months revenue is going to be. So in the first 3 months is where you will be required to hire people, train them, and then execute the sales project. So the revenue will be coming only after say 3 months for the hires that you are taking, which means that to pay off that salaries for that 3 months, you need funding. Okay. So to estimate funding is another reason. Then understand profitability. So typically, like when you do the financial model, you understand that if at this level of sale, what is the profit going to be? And like when you increase the sales, what is the profit going to be? Or if the sales decrease, what is the profit going to be? So you can work out on different scenarios and understand the profitability of the business that you are doing, whether it be service, product, goods, trading, manufacturing, whatever it be. You can understand the level of profitability that your business would be having. Then evaluate risk. So this is as per plan. What if like kind of an external element or like some sort of risk element also gets added to this? For example, for the next 3 months, if the revenue is not going to come as planned, or like kind of maybe like kind of this 3 months of hiring people, it takes, I mean, the 3 months training for the hired people takes around 6 months. What is going to be the outcome? So in such scenarios, like kind of you can uh, identify such risk, like put it into the Excel, and like kind of understand what is the outcome going to be. So to evaluate the risk, you can use the financial model. Then again, obvious thing which everyone knows, present to the investors. Obviously, the investors would be asking for a financial modeling and also like kind of a 5-year projection, whatever it is. So that's another reason why people typically do financial models. So 5 reasons. One is to plan growth, estimate funding, understand profitability, evaluate risk, and present to investors. For investors, financial models show how realistic the business plan is. So that's again like kind of another important thing. For the investors, it should be like kind of maximum realistic and achievable. Like rather than like kind of bluffing on numbers, it should be like kind of more realistic and believable. Because that this Excel is going to be your business plan, how you are going to deploy your capital, how much hiring you are going to do, how much sales you are going to generate. So all these things should be realistic. Okay. Then components of a financial model. I mean, again, these are not the all components. These are the basic components. The basic financial model consists of three core statements. One is the profit and loss statement, like how the business earns, what is the profit of the business. Okay. Then the balance sheet, what are the assets and the liabilities of the company. Then the cash flow statement, how cash moves through the company. So like I've told in my previous session also, like there is a lot of difference between the profit and loss statement and cash flow statement. So profit and statement, loss statement is like kind of uh, more kind of the result of a business, but that has nothing to do with the cash flow. For example, if you are generating a revenue of 1 crore and you're having like an expense of 90 lakh rupees, in your books, you will be in profit of 10 lakh rupees, right? But of the 1 crore, for example, you haven't received 50 lakhs rupees is still pending with the customer, which means that you got only 50 lakhs and you still need to pay 90 lakhs of expenses. In that case, you are running in a cash negative balance of 40 lakhs, which you will have to like kind of get support from external person. So that's why I'm telling like kind of there is a lot of difference between profit and loss statement and cash flow statement. So investors would be interested in knowing the profit and loss statement and the cash flow statement. Okay. And also like as a founder, for you to like kind of understand the business and perform the business in a neat manner, you need to prepare both these. Okay. Because if you depend too much on the profit and loss statement, the thing is that you may underestimate the cash requirement in your business. So these are the three basic components: profit and loss statement, balance sheet, and cash flow statement. Then now we are going to the revenue assumption. So typically, like when we build the financial model. So the flow typically comes from, I mean, primarily we need to have the profit and loss statement. For that, we need to know the revenue, we need to know the expense. Then the remaining is the profit. And this profit gets added to your capital and it goes to the balance sheet. Okay. And items which do not come in profit and loss statement are, for example, the investment that you raised, that will not come in the profit and loss statement. The assets that you purchase, the laptops that you purchase, the furniture you purchase, the rent deposit that you pay, that won't come in the P&L. It will be coming in the balance sheet only. Okay. So those things should be needed to ascertain the balance sheet. Then cash flow. So cash flow is like kind of what, cash coming in and cash flowing out. So again, like kind of it's actually derived from the balance sheet and P&L in accounting sense. Okay, I mean when we do it in a technical way, we derive it from the profit and loss and balance sheet. So to arrive at this profit and loss, balance sheet, and cash flow, the primary thing is again like I told, balance, profit and loss. For that, the first thing what we need to know is the revenue. Okay, so revenue projection should always start with business drivers. So this is what typically people forget to do. You cannot simply like kind of project a revenue of 10 lakh rupees in 1 month. So that should actually have a business driver. So I've noted it down here. So if you see here, in retail business, revenue is equal to customers into average bill value. So you need to estimate the number of customers that is going to come to your website or your store, and what is the AOV going to be, what is the average order value going to be. So this should be, the revenue should be a multiple of that and not simply 10 lakhs or 15 lakhs. Okay. Then in SaaS business, revenue is users into subscription fee. So what is the number of users that you expect to onboard in your platform? What is the subscription fee per user? If you have 3 to 4 models of subscription, in model 1, how much users are going to come? What is the subscription fee? In model 2, how much number of users are going to come? What is the subscription fee? Like that, you'll have to take and sum it up and arrive at the revenue. In the case of manufacturing, revenue is equal to units sold into price per unit. So there you will be following on the number of units. So if you look here, the business drivers are customers in retail business, users in SaaS business, and units sold in manufacturing business. Okay. So always your revenue should be like kind of starting from the business driver. It shouldn't be a like kind of blind projection, like kind of 10 lakh, 15 lakh, 20 lakh, like that. If you do like kind of and do a 20% hike year on year, I mean, those things won't typically work when you are doing a financial model for a purpose. Okay. These things you can do it maybe like kind of uh, to understand the potential of the business. Maybe you can do that. But again, like kind of taking vague assumptions won't help you in that aspect. Okay. So a good model is always driver based, not guess based, like the statement I've mentioned there. So this is very critical, very important. So while uh, arriving at your revenue, it's always derived based on the drivers, and it's very important that you do it based on the drivers. Okay. Now we have the cost structure. After revenue, we have the expenses. So cost typically comes into 2 categories. We have the fixed cost and variable cost. So fixed cost is something which do not typically change depending on the driver, like kind of the number of units sold, or like kind of the number of users, or maybe like kind of the number of customers. So salaries, rent, software subscriptions, these are like kind of fixed cost. Again, salaries can be variable. Maybe like kind of if you are into a manpower intensive business, to generate more revenue, you may be required to hire more people. But again, like kind of in general sense, salaries is considered as a fixed cost. Then we have the variable cost, which is directly linked to the revenue. So if you need to sell 1 unit, you need to buy half unit of this thing. So if you want to sell 100 units, you need to buy 50 units of this thing. So that's a pakka variable cost. That's directly related to the sales that you're going to do. Okay. Then sales commissions. So for example, you have channel partners, or you have like kind of some sort of arrangement with some association or something. In that case, you need to pay some commission to them. So that's actually going to be a variable cost. So whatever sales they are going to bring to you, you need to pay a percentage to them. So that's again linked to the sales, and it's going to vary. Like if you are doing 10 lakh, it's going to be 1 lakh. If you're going to do 5 lakh, it's going to be 50,000. Okay. Then logistics, again, like kind of if you're uh, in the business of retail, if you're doing online selling, I mean, you have shipping cost. So when the number of units increases, when you're selling more products, that means that the shipping cost will also increase. Okay. So this bifurcation you need to have. What is the fixed cost going to be? What is the variable cost going to be? And again, like kind of when you do the salary calculation, there also you need to be very clear on the estimations that you are going to take. For example, like kind of how the manpower hiring is going to be. Maybe like kind of currently you may be a team of 5 people, but going forward you need to hire one chief technology officer in 6 months, one accountant in third month. So all those things you need to plan. And when you are going to hire these people, what is this approximate salary going to be? All those things you need to ascertain. Okay. And another thing what typically people forget is the rent. Even though rent is a fixed cost, when you increase the number of like kind of people, you may be requiring to get additional space also. So all those things should be factored in your business model. Okay. So understanding this distinction helps determine operating leverage. Okay. So then we have the working capital assumption. So like I've told earlier, so this working capital assumption is the direct explanation what I have to give you on the difference between the profit and loss statement and cash flow statement. Many businesses fail not because of losses, but because of poor cash flow management. Okay. So this thing is another thing which we need to like kind of factor into our financial model. Uh, these are again examples. I have given 3 examples there. One is the inventory days. For example, if you are in an inventory based business, uh, how long stock sits before being sold? So, for example, typically people follow a standard protocol of say 2 months of stock. So you need to have 2 months of stock in your business because else you may run out of stock, or maybe 15 days of stock, depending on the business, depending on the logistics, like how long it takes for the uh, goods to arrive your factory after you give an order. So all those things. So if you deploy too much amount on the inventory, which means that this inventory is going to be there in your factory, and that is idle cash. Okay. But if you look at the P&L, the P&L won't reflect this inventory thing, because in P&L, how we arrive at gross profit is like sales minus cost of goods sold. What is cost of goods sold? Opening stock plus purchases minus closing stock. So this stock element kind of thing gets nullified in the profitability calculation. But if you look at cash flow, your cash is stuck in the inventory. So how long the inventory sits is very important, and that is a main assumption that you need to take. For example, if you are importing goods from another country, say from China, and you are selling it here, you should be having at least like kind of 2 to 3 months of stock, because once you place an order to China, for your goods to get like kind of processed and that to reach India, get the customs clearance and reach your factory, it may take around 60 days. So if you don't keep 90 days stock, that's going to be a problem for you. So you need to factor those things, because these things again, like I've told, it may not be affecting the profitability, but 2 months of stock may be like kind of what 50 lakh, 60 lakh rupees. But if you look at the profit and loss statement, your profitability says you are in 30 lakhs profit, but this 50 lakhs should be, you should park it for the inventory. In that case, the fund estimation that you make is going to be wrong. Okay. Then the second one is receivable days. How long customers will take to pay? That's again another assumption which you need to like kind of make, and it should also be realistic. So typically, like kind of people would take around 7 to 15 days to make the payment if you give an invoice. But if you're again, if you're into the business of exporting, it may take 90 days. So you need to factor all these things. Again, if you look at the P&L perspective, the moment you raise the invoice, that is recognized as the revenue, and all the expenses are deducted and the profit is arrived there. But if you look at the receivable thing, it's again 90 days you will take for that money to hit your bank account, which means that even if you have done 1 crore of sale, that 1 crore hasn't been hit in your bank account, which means that you look profitable in the books, but in cash flow, you don't have that cash. Okay. So receivable days is another thing which is going to be affecting the working capital thing. Then payable days. How long before you pay suppliers? So for example, like uh, you, like I've told, in most of the cases, when you import from another country, you may have to make the payment in advance. You may not be getting a credit from your supplier, but you'll have to give a credit to your customer. So that thing would be there. Or maybe like kind of if you're paying your rent, for example, rent becomes due on 30th of every month, but you get like kind of 10 to 15 days to pay the rent, which means that even though that expense is booked in the month of March, you need to pay it only in April. So all these things also affect the cash flow. Okay. So inventory days, receivable days, payable days. These are main three things which affect your cash flow. And you need to make a very clear cut assumption on these things, not just on the profitability aspect alone. You need to have a very clear cut idea on the working capital assumptions as well. These directly affect the cash availability. Like I've told already, these things actually affect the hit the cash that you have in your hand. Then funding requirement, financial models reveal critical funding insights. So once you prepare the financial model, it's going to reveal you that what is the cash runway when the business runs out of cash. So if you're creating a month-on-month P&L and month-on-month cash flow, it will show you like kind of in which month you are going to be in negative cash flow. So if it says in 6th month you are going to be in negative cash flow, which means that you just have funds for operating for the next 5 months. You need to raise funds immediately, or in the 6th month you will become negative cash flow, which means that you will not be able to meet your expenses. Okay. So it shows the cash runway. Then what is the capital needed? So for example, from 6th month onwards, you are in negative cash flow. And this will go on till around 12th month. And at the 12th month, the peak negative cash flow is going to be like the sum total of past expenses is going to be 5 crore. Okay. Then in the 13th month, it starts becoming profitable. This means that you need to raise at least 5 crore to stay cash positive in all the 12 months or like all the upcoming period. So this would help you to like determine what is the capital needed. Okay. Then funding duration. How long will the funding last? So for example, even if you raise 5 crore, then again like when is it going to be negative again? Because for example, if you are in the production stage or development stage of your business, in that case, like the revenue, it may take a bit of time to hit in your bank account, or like start generating revenue, it may take a bit of time. So in that case, again, like you need to know how much this funding is going to last. And typically, like people raise funds for a duration. People raise it for like 18 months of runway, 24 months of runway, like that. Okay. This helps founders answer an important question: how much money should be raised? So only once you prepare a proper financial model, you can come up at a like exact amount which you need to what you need to raise. Okay. Then sensitivity analysis. So this is something what I typically like ask every founder to do, because financial models must consider uncertainty. So see, if everything goes good, it's well and good. Okay, fine. Your Excel is superb. Your Excel is what it is going to be in actual scenario. But for example, just imagine the case of a person who has created a financial plan in say January 2020. So you have done it for the 12 months. See, March 24, 2020 onwards, we were in lockdown. So for the next 1 year, like it was a complete shutdown. We had 2 sets of lockdown in India alone. So the business didn't go as planned. I mean, everybody was into uncertainty. So that's why like we need to factor for the uncertainty element also. Okay. So that is why we need to have a sensitivity analysis. So again, in the Excel, if you create a sensitivity sheet, uh, what if I am, for example, now you are targeting like 1,000 customers. What if it is 500? So you make it 500, it should show what the profitability will be, how much the profitability will reduce to. Okay. And what if like you don't get a hire for the budget that you have expected? You need to pay extra for the salary. So what is it going to be? So all these things you should be factoring into the financial model. So that's what the sensitivity analysis does. So what happens if sales comes lower than expected? What happens if cost goes higher than planned? What happens if the customer delays the payment? Like for example, you expected it to be 30 days. What happens if it goes to 60 days? How your business is going to? So these things you should consider and prepare for multiple scenarios. So there should be a best case, there should be a base case which is more realistic, and a worst case. So when you consider these three scenarios, you will also have more clarity on your business. Okay. Then common financial modeling mistakes what people do. One, overly optimistic revenue. Like people exaggerate. Like enough. See, everybody is optimistic. Everybody is positive. Everybody wants their business to grow. Like I also believe that my business can be a $1 billion uh, business. I can generate $1 billion revenue. But the thing is, like, kind of, see, overly being optimistic doesn't help me in planning. So if I assume that tomorrow I'm going to make 1 billion in revenue, I will have that level of cost also. See, how am I going to make that much level of revenue? How my sales is going to come? So we should not be overly optimistic while doing the revenue. Revenue assumptions that are too ambitious without market evidence. For example, you are in a niche segment. You're operating in a very niche segment and you have very limited customers. And you are telling that the number of customers that I'm going to have is 1 lakh. But the actual customer you will get in your entire lifetime is say 5,000 only. So what's going to be like if you do it in that manner, you are going to be very optimistic, and that's not going to happen also. So all your plans would be in like kind of uh, it's going to be vague. Okay. Then ignoring working capital, failing to account for cash tied up in inventory and receivables. As I've already told you, like people typically don't do this. They just rely on the profit and loss statement and assume that the profit and loss statement is the cash flow and proceed with the business. That's very wrong. You need to account for the working capital also. Then underestimating cost. Like I've told about estimating the revenue, underestimating cost is another thing what people do. Operating expenses often exceed initial estimates significantly. So, for example, see, always you need to factor in for the hiring and all. Like kind of people like kind of expect, okay, this person I'll be paying this much, this role I am going to pay this much amount. I mean, you need to have clear cut market validation, like how much it is going to be. And for example, when you are planning for a rent, so it changes from area to area. So those things you need to factor in. So maybe like kind of you might have considered the rent in a remote area, like kind of maybe in your hometown, the rent would be like say 50 rupees per square feet. But when you go to like Bangalore or any other city, it's going to be 100, per square feet. So underestimating the cost is a very common mistake what people typically do. Then unlinked statement, financial statement that don't connect loose integrity and accuracy. So this is another problem. Like people come up with hard coded numbers in the financial model. This should always be formula linked, and you should, when you're creating an Excel or Google sheet, the thing is that it should always be linked to your drivers. And when you change one thing in one place, it should change automatically in every sheet. So that should happen. Then only like kind of people can work out scenarios. Even when you need to make some change in the future, you can make that change. Else it's going to be like kind of when you make change in one place, you have to make change in 100 places. So that should not be the manner in which a financial model should be built. So typically when we build, we create a key assumption sheet or an input data sheet. So that is the only place where we manually feed the data. Okay. The remaining everything we use formula and like kind of connect it properly. So whatever you need, you can enter in the input data sheet. So that means that if you reduce the number of customers in the input data sheet, the revenue will automatically reduce in the in your P&L. It will reduce in your cash flow. It will give that effect in your balance sheet. It will be linked in that manner that one change in one place will make the change in all other places. Okay. A model must reflect how businesses actually operate. Okay. So the common mistakes, one is overly optimistic revenue, then underestimating the cost, then ignoring working capital, then unlinked statements. Then tools for financial modeling, which I've already told. One is Microsoft Excel. Excel is the most powerful tool, and like kind of it's the industry standard tool for financial modeling worldwide. But if you want to work on something on a cloud kind of thing, Google Sheet is a better alternative. So that like if you can collaborate and work, even though Microsoft Excel have an online version, Microsoft subscription is comparatively costlier, and like kind of you need to have the subscription is what I believe to work it on online. But in Google Sheet, when you have a Gmail account, you can easily work on it. Then FP&A software, there are certain software which typically kind of help in doing the financial modeling thing. But I mean, I always do on Microsoft Excel and in some cases Google Sheet, depending on the client requirement. Then BI dashboards, like Power BI or Google Data Studio that could give more visualization effect to your things. For example, if you want to see how your revenue is progressing, it's always better to see it in a graph. Okay, so those things. Then Excel remains the most widely used modeling tool globally, that I've already told. Okay, so key takeaway: a financial model is not about predicting the future; it's about understanding the financial implication of business decision. So we are not actually predicting the business outcome or anything. It's about one decision you take now, how it is going to impact your business in the future. One hire I reduce, how much revenue is going to reduce? One, if I increase the marketing spend by 1 lakh per month, how much is my revenue going to increase? So it's all about what is the impact of one financial decision that you take. Okay. So that's it from my end. So what I'll do is we'll have the Q&A session now. And as usual, I've kept my WhatsApp group QR and my LinkedIn QR as well. So you can connect with me on LinkedIn and join our WhatsApp group as well. And one thing what I'll do is that I'll send a couple of templates to everyone in your registered mail ID, in the mail ID in which you are registered for the session. Now over to you guys. Yeah, thanks, Raj. Thanks for the. Yeah, Jesh,
Thank you.
You can ask those. Yes.
Yeah, thank you for the session. Yeah, like we sign a contract with the customer, and after some time, the customer renegotiates the pricing. So in this case, how can we address?
Who negotiate the pricing?
The customer.
Okay, see, that's again see, we need to have an idea of what our indicative pricing is going to be. So you cannot simply say, for example, if in my business, I have an idea of what the pricing is going to be, this set of services. So these things, we should follow some industry standards and we should understand the market, whether we will be able to charge this much amount from the customer. So even though the customer dictates the pricing kind of thing, you would be having a benchmark or you would be having a range is what I believe. So it's not simply the customer coming and telling you should sell your product for 100 rupees, whereas the market rate is 1000 rupees. So you won't sell that for 100 rupees. So there will always be an indicative range and you should work on that indicative range.
Okay, thank you. And one more question. What if the customer holds the some amount? How can we price in? Like if a customer, he has to pay in 1 month, but he's holding some amount for some time. He's not paying.
I mean,
Yeah.
so that thing can happen in business. That's what I told. You need to factor in all these things in your sensitivity and when you do make business assumptions. So see, in real life scenario, if you have a proper agreement, you can always challenge these things legally. But if you don't have a proper agreement with the customer, I mean, again, if you have to follow up with the customer. But when making a business plan, it's all about the assumptions that you make. Even if a customer pays in 30 days, you can be a bit more conservative and keep it 40 days. Okay, so such things you can factor into your business model.
Yeah. Thank you very much. Thank you.
Yeah. Thank you. Anyone else? Yeah, Jidesh, you can go ahead and ask the question.
Abhijith, as always, really nice presentation. So my question is, say if you are in an ideation stage, right, or let's say you're going to a pre-seed in that stage and trying to build this financial model, right? How does one even begin to put all this together? I know this is a complex question. But I'm struggling with this right now, so that's why I'm asking the question.
I mean, so typically, if the primary thing I would suggest you to do is work based on the revenue, because if your revenue thing is sorted, if you have a plan on how your revenue is going to come, what are the different products or different services that you're going to offer, everything else would come in place is what I believe. So typically when I work on any financial model, I primarily work on the revenue, because see, the entire business is dependent on the revenue. For example, if you want to do like 1 lakh rupees revenue, or like if you want to onboard 1,000 customers for that reason, you will know like how much manpower you would be required. For example, in my business, okay, so my business, it's always like customers into like average revenue per customer. So in that case, if I want to onboard 10 customer, I know that how much clients my staff would be able to like handle. So if I want 10 customers, then I know like I need 3 staffs for that. So once the revenue thing is sorted, the remaining things would come into place. Then I know like I want 3 people to if 10 people, 10 customer is what I'm going to do, okay, I want 3 people. And if it is 3 people, then like I want to buy 3 laptops. And if it is 3 laptops and 3 people, plus me and another person, so 5 people, we need a 5-seater cabin in a co-working space. The co-working is going to cost per seat 5,000 rupees. So 5 into 5, 25,000 rupees. Then I need to pay 6 months of deposit. So 25,000 into 6, 1.5 lakh. So that is how like we do the like
Yeah.
thing.
Yes.
And primarily like firstly when you're working on a single sheet, put all your assumptions in place, and then you start building the profitability sheet and all those things. And now with Claude and everything, like it's much more easier to do the financial modeling. But still, like if you are very serious about that, like I would recommend to seek professional help from people like us, because
Yeah.
uh, we know like how industries work in different segment, like what is the standard going to be, and we do a lot of research also. Rather than like converting what is in your mind, we question you also. We question your assumptions also. So that would actually like add a lot more value to the financial projection that you're creating.
Yeah. Just one follow-up, right? In the
Yeah.
financial model, okay, mine is going to be a manufacturing or production service. So, and I don't come from that background, therefore I don't. I'm sure when I start establishing things, there's going to be that unexpected thing that comes in. In this scenario, is there a system where I can just put a certain amount aside as a rainy day or miscellaneous or some category where I can just ask for funding, like, hey, I need, so my calculation says I need 1 crore, but I know that it's going to be more than that. So I'm going to ask for 1.2 crores, and the 0.2 will go into this rainy day or anything like that. Is that possible in this model?
That's different. That's definitely possible. See, again, like if I haven't shown any model to you, like that's the
Eh,
primary thing. I mean, so typically when we build Excel, when we build financial model, it's always like we take the client's recommendation, like what they really need to know. See, the
okay.
investor presentation is a different thing. So that's like okay, we need that for to present to the investors. But primarily, it is most important for the founder to know like how the business is going to be. So typically, like we help the founders build that. So if you want to have some reserve amount or something like that, yeah, those things we can factor into the Excel. That because it's an Excel, like we can do whatever you want.
Yeah,
Okay,
yeah.
so that can be done, and primarily, I've told, we, I mean, at least from my perspective, me as a consultant is never adamant on any standard template or anything. I always try to make it more user friendly for the customer, because or the client, because they are the ones who want to know like what it is going to be. But if I'll help them with advices, like if they are tracking something unnecessary thing, I'll tell that, see, this is not a thing which is required. But if they have a genuine concern and like that is the way in which you are going to understand, I'll make it more understandable for you.
Thank you.
Yeah. Thank you, Siddhesh. So I don't have anything with me right now, Anil. I've seen your question, but I'll be definitely sharing it over email, and maybe like we can plan a session in future with where I practically take a financial model. And see, I have couple of templates with me now. But again, if I show it now, like if it's going to be a lot of question, I think it's better we'll have a separate session on that. We can always do that. Anyone else? Okay, so if there are no more questions, we'll wind up the session. So thank you, everyone. Thank you once again for joining today's session. So in the next session, we'll come up with a more interesting topic, and like what Anil has already mentioned in the group, we'll always plan. We'll definitely plan for a session wherein I'll practically take you through a financial model, and if possible, I'll try to do a session on building a financial model as well. But I'm not sure like whether we can do that in 1 hour. That's why I haven't taken that extra step this time. But obviously, we can try doing that someday. So thank you, everyone. Thank you. Bye. Have a good evening.